Okay, hi everybody again. This is going to be part 3 of the series on income statements for the Multi-Project Cooperative. Part 3 is going to focus in on how the net income is allocated to the members. We can see right here how it was allocated to the Project Growth Fund and to the General Growth Funds and to the Education account. That was simply 60% of the 10% of the surplus reserves, 10% for the surplus reserves, and 60% of that for the growth for the project, 30% for the general growth fund, and 10% for the education fund. All right, now we go to the capital account allocations. This is just a summary that 90% goes to the members and 10% goes to these surplus reserve accounts. All right, so here we have our projects again: co-op administration, food truck, and t-shirts, and the total for the projects. Here we have our patronage dividends. This is what the food truck brings to their members. And then the members who worked in the t-shirt project, this is how much money they're going to divide. And next we have how much they're going to retain. T-shirts is going to retain 24% and pay out 76%. Food truck has decided to retain 35% and pay out 65%. And then the co-op administration is going to retain 33.3, which is the weighted average between these two, and is going to pay out 66.7%. All right. So here we have members: Jackie, Daniel, Carol, and Tim. You can see that Jackie, she worked in the co-op administration. Maybe she's the general manager. And she looks like she's the manager, the project manager for the food truck, because she's getting more of the points. She's getting more of the responsibility, more of the effort, more of the productivity that goes into the food truck. But she did not work in the t-shirts. Then we come down and see Tim. Tim worked a little bit in the co-op administration, maybe repackaging things, picking up some things, but he put in a few hours, so it didn't look like it was very heavy responsibility. But then he did a little bit more for the food truck, helped out there a little bit, got some hours, enough hours to pick up $745 worth. But most of his work was, he must be the project manager of the t-shirt business, so he's going to get most of the money there. And it looks like Daniel and Carol are pretty much helpers and assistants in both projects, because the project managers are Jackie and Tim. And Daniel, he also did a lot of co-op administration. Let's say he did the bookkeeping and the treasury and a lot of the paperwork. So you can see that because of their different points, they get a different percentage of that 11,182. So basically, what it comes down to is that Jackie got 34% of this 11,182. That's really what it comes down to, is that 34 is a percent. 24%, 18%, 6%. And then each of these projects puts in 8% of their net income towards the officers and the co-op staff. So the food truck allocated or transferred to the co-op administration $994. This $994 goes up to this number there. And this $181 goes up to this number here. So these two numbers combine into this number, which is the amount of money, patronage dividends, which will now be divvied up to the people who worked in the co-op administration staff. And they determine between themselves how many points and responsibilities they have in order to determine how they divvy up that money. Okay, so This money is paid out, and then it's zeroed out here because they can't transfer any money to themselves, and the co-op administration zeroes out. And as it comes down, we see that this is how much money the food truck allocated to its surplus reserve accounts, and the t-shirt project allocated these amounts to their surplus reserve accounts. And over here we start to see the totals. And these yeses are just to confirm that all the numbers are automatically configured and added up and everything is a-okay. All these yeses confirm that there are no mistakes in the arithmetic. Alright, so I want to look more specifically at this food truck. 11,182. So I want to take another here. This is looking at the food truck more specifically. As you can see, their net sales 20,000, their cost of goods sold 5,230, operating and net non-operating expenses. All these numbers come from the page previous. Now, here you see Jackie, Daniel, Carol, and Tim. This is how many hours they worked in this project, in the food truck project. And then they get their job levels. See this job level? So Jackie has a 2.8 job level. Tim has a 1.2. Daniel has a 2.4. Basically, if there were no adjustments made, Daniel would always make twice as much as Tim. 1.2, 2.4. 2.4 is twice as much as 1.2. So if you have no adjustments, Daniel will always make twice as much. And Jackie would make 2.3 times as much as Tim. But then you have this adjustment right here. I'm going to do this from the scale adjust right here. You see it's at 0.06. Watch, I'm going to change this number, and these scales change. This is at 0, so you can see here that Daniel is making $25 an hour and Tim $12 an hour. So basically, Daniel is making twice as much money as Tim. But if you don't want that, you don't want such inequality, so to speak, in their pay, you use this adjustment. And that adjusts these job levels so that the lowest paid member can get a fair and decent wage. So here we've adjusted it, and now the difference between Tim and Dan is not twice as much, but it's less. So this scale adjust is a way of leveling the playing field. Now, if the food truck starts to get really profitable, Jackie, who is the project manager, has the authority to increase her profits, to increase her income by leaving Tim at $14, $15 an hour. And maybe as the food truck got really profitable, Jackie could allow her income to go up to $30, $35 an hour, leaving Tim at around 15 because that's what they've decided on. And that's part of the incentive of productivity in this multi-project cooperative, is that the lowest paid people are taken care of. They're given living wages. But there's incentive for the managers, for the brains and the power and the desire behind these things, to increase their own income. And that's an important part of being productive. They can share that income, but at the same time, some of these entrepreneurs have real talent and real skills that they've spent years developing, and they deserve these higher pays. And this system allows them to develop that. Okay, so let's go back to the other. Come down here. So here we see the total amounts. This is Jackie's total amount of hours between co-op administration and the food truck. Her total amount of labor patronage. Her percentage labor patronage at total, what she's being retained. And this is actually a weight between the food truck and the co-op administration. This retained percentage comes from how much is being retained from one project and how much, and a different percentage is being retained from the co-op administration. That's all figured automatically. This is how much she's being paid, $3,114. This is her portion of the interest dividend, which I think was $18 up above. And it goes on, total dividends plus interest. So this is her income per hour for the month. She made $27.61 per hour that she worked in income. And she'll take this $4,783 and at the end of the year pay her personal income taxes on it. But you can see that each of the members, how much money they make per hour, this is all figured up automatically. This is how much money here is retained per individual. Comes down to collective accounts retained this much. Total retained was $5,871 for the month, which is about 40%. Now, from different cooperatives around the world, so especially Mondragon, they like to retain around 40% of their income, of their net income, for growth of the cooperative. And so this model, when you take into account the members retaining portion of their patronage dividends, you can reach this 40% reserve capital, working capital for the cooperative. And most of it, a large part, most of it comes from the members' accounts themselves. So the members have a larger stake in the cooperative. They get more control, they have more equity control, member control. So the total retained for the co-op administration, and so it moves on like that. So this is total retained. This is total retained for the projects, 36%, and 4% was for the co-op administration. All right. So that kind of brings us up to there. On the next video, I'll give you a preview. We're going to look at the general ledger, which is automatically configured from, come back over here, that was the income statement. The general ledger is automatically configured. So I'm going to run down here. All these little journal entries in the books are automatically configured at the end of the month for closing the books. I'll clean it up a little bit and get you part 4. All right.